Hey guys, welcome back to another video. Today we'll be doing an analysis of Activision Blizzard. And for all of you unfamiliar, they are a video game holding company. So starting off with the overview, their current PE ratio is at a 19.79. So this is good because the goal is to look for companies with no more than a 20 PE. So the PE ratio is important when looking at a company because it shows how risky the investment will be. If a stock is high but the EPS is low, it will result in a high PE ratio since the earnings can't justify the stock price. So the next thing to look at on this page is if they offer a dividend, which they do. It currently offers a 0.70% yield, which equates to about 0.47 cents per share. So investing into a stock with a decent paying dividend is always a bonus because it allows you to collect consistent passive income without having to worry about the actual stock price too much. Alright, so moving into the income statement now, I always like to start off looking at their revenue. So the revenue growth over the past 5 years is up about 1.5 billion, which is about a 22% increase. They're currently bringing in 8.09 billion in revenue from the 6.61 billion in 2016. So this is really nice to see. So the next thing to look at is the net income. So Activision Blizzard's net income growth over the past 5 years is up about 1.24 billion. So this is a great increase to see as the net income shows you how profitable the company is. The last thing on the income statement to look at is the shares outstanding. So they currently have 771 million, which is an increase from 2016 when they were at 740 million. So preferably you want to see the shares outstanding decrease throughout the years because the more the shares outstanding goes up, the smaller the percent individual investors actually own of the company. Moving into the balance sheet now, I like to always take a look at their current assets. So with their current assets, it's been doing really good, increasing almost basically every year. Over the past 5 years, they more than doubled what they've had, as they're currently at 10.57 billion, up from the 4.64 billion. So the next thing I want to look at on this page is their current liabilities. So they also have been increasing, but at a very slow, steady rate, which is nice to see. When seeing a big jump in current assets, you usually also see a big jump in their current liabilities. Clearly not in this case though. They're only up about 40 million from 2016, as you can see, because they're at 3.1 billion, which is only up from the 22.66 billion. So also remember the number 3.1 billion because they have 8.65 billion in cash alone. So this is a great thing to see because this means they could wipe out any current liability at moment's notice. Alright, so the last thing to look at on the financial statements is the free cash flow. So as you can see, it has an increase from 2.02 billion to 2.17 billion over the past 5 years. So this is really important because companies that have a lot of money on hand have the advantage of being able to pay off any debt, invest into future growth, or pay dividends. So this is a really important aspect to see growing over time. In conclusion, guys, this company's got some great financials. The only thing I want to see them work on is buying back shares, so their shares outstanding will start decreasing. Overall, though, it looks like a promising buy right now. It's currently trading in the $60 range, which is a dip from where it was at the beginning of the year, since it was about $100. As you can see right here, it was at 103-ish, and now it just fell all the way down here. So I want to point out that I am not a financial advisor, so I recommend doing more research before coming to the conclusion of buying or selling this stock. If you guys have any companies you want me to take a look at, feel free to comment them down below. Otherwise, thank you guys for watching and have a nice day.